When I think about what we're feeling today, how we're feeling, we're sort of slowly recovering from whiplash because 2021 was the single most profitable year in real estate history. So, best for single family, best for multifamily. And we now live in a new normal that actually is closer to what real estate used to be in the 70s or 80s, right? Recent numbers, with the exception of the report that came in today, if you look at the last 6 months, they've all been phenomenal reductions. Once again, the market's correcting, and it's correcting in the favor of real estate investors. Well, welcome everyone. This is Real Estate Trends 2024. This is a data-driven and chart-heavy collection of lots of interesting insights that will help you make high-quality investment decisions in what is an extraordinarily high interest rate environment, and hopefully it also helps you focus on brand new opportunities that this real estate recession has created. We are data scientists, and we look at today's real estate market with a mixture of some amusement, also some surprise, and you are about to find out why, especially when it comes to the single family market. So, when I think about what we're feeling today, how we're feeling, we're sort of slowly recovering from whiplash because 2021 was the single most profitable year in real estate history. So, best for single family, best for multifamily, right? Best for transaction volume for both. And from those heights, we came into 2022, then into 2023, and everything's really changed in the last 2 years. And we now live in a new normal that actually is closer to what real estate used to be in the 70s or 80s, right? And in 2024, we're now beginning to see a massive disconnect emerge between the mindset of investors and the opportunities that are available in the marketplace. So, and our job today is to highlight that disconnect and talk about the risks today, that there's plenty of risks and opportunities. And we want to tie it all together with how the US economy is doing. We'll talk about single family real estate. We'll talk about multifamily. Other asset classes, we'll leave that for the Q&A if you want to ask me about other asset classes, which are also surprising, by the way. We'll start by looking at 2023. So you see that here. We'll then take a look at the future. So we'll do some predictions. And our economic forecast, which is going to be in this section, will cover GDP and recession and interest rates and unemployment and inflation. And then we're going to jump into real estate, and I'm going to show you how real estate is likely to perform in this environment. We'll finish with the favorite section. So for the 9th year in a row, we will share the analyst pick for best cities and states in the US for real estate investing. And then we'll finish with me sticking out my neck and giving you my top pick for best city in the US to invest in. Now, most of you know us, but for those that don't know Anna and I, we are quirky, opinionated data scientists. We are technologists. We both buy and build large projects. Our portfolio of 31 properties is worth $1 billion. Anna, this is out of date. We're at higher than 31 now. And over 1,000 very data-driven, somewhat nerdy investors have trusted us with their money. This is one half of our portfolio. We use data science and we use it to invest in 8 different asset classes. So multifamily value add, apartment new construction, single family built to rent, fourplex built to rent, student housing, built to sell townhomes, self-storage, flex industrial. So lots of different asset classes. And each of them teaches us something different, including sometimes saying, don't do it again, and makes us better at our job, which really is to protect your investment. Now, I'm going to say something. We've gone full cycle 7 times on the projects that I'm going to show you today. Overall IRR of 35% a year, an average annualized returns of 47% a year across those 7 exits. What's really cool is we're missing 2 of our projects because we're doing final math. So in December, we exited a project. We also exited a project in January this year. And while the overall IRRs for those were a bit lower than our average for the first 7, we are very proud of these projects, but because these projects faced all of the headwinds that came with the interest rates. So we're proud of the 8th and the 9th exits. And so the next time we do a webinar, you will see updated slides with 9 exits. So looking forward to number 10 sometime this year. Our investors really like what we're doing. Here's Jennifer. She's a super experienced investor, and she compares us to much larger companies that have more projects, and she thinks we come out ahead. She also likes our high efficiency processes. She loves the fact that the team, the core team has not changed since the beginning of Grow Capital's inception. Here's Dr. Parda. He's a general partner with lots of deals on his own. both as a general partner and also as a passive investor with us. So you can check out his comments in orange on the bottom right. So it really comes down to use of data to optimize our results, and we're very, very good at that. And that's why Dr. Parda keeps coming back to us to invest. And in fact, he has also accepted a position as a board member on one of our companies. All right, folks, let's get the boring legal stuff out of the way before we dive into some cool stuff. Friendly reminder, this webinar is for educational purposes only. Just because we're sharing our personal opinions, it doesn't mean you're guaranteed to make a fortune in real estate. So do your own research, consult professionals, and remember, investing in real estate and stocks is all risky stuff. So, and don't be shy to type in your questions, right? We are going to answer your questions at the end. We'll have plenty of time. And don't worry if you miss anything, we'll be sending out a recording in 48 hours. All right, 2023. Well, this is going to be a very hard year to top. And that's a very surprising thing to say. I call 2023 the last leg on the long road back to a normal real estate market in a normal economy, right? Because 2019 was the last normal real estate year. And every year since then has been bizarre, up or down. And 2023 was no exception to that rule of bizarreness. In fact, in 2023, the US economy has done what I consider to be impossible. Despite astonishingly high interest rates, plus quantitative easing by the Federal Reserve, the economy beat everyone's predictions, including my own. You see this cartoon on the left, right? It's actually a true representation of the economy. I mean, the economy is a train that is just smashing through all of our bearish warnings, all of our bearish projections, because unemployment, it remained extremely low. Inflation came down pretty smoothly. Energy prices were lower than we thought. Ukraine war, no Ukraine war. And by the end of the year, we actually see no evidence of any supply chain issues anywhere in the world. And I hope to get to say this again, but the US economy, it crushed it. It absolutely crushed it. In 2023, the US economy led the developed world. And here, as you can see in the graph, we are now also projecting that in addition to that amazing numbers in 2023, we're likely to crush it again in 2024 and lead the developed world again. That's Goldman Sachs' prediction. And they're also pointing out that even lagging sectors of the economy, like manufacturing, will recover in 2024. So shocking numbers. Never thought I'd say this at the beginning of 2024. And the inflation slowed and was pretty evident everywhere in the economy. While healthcare premiums rose by about 7 or 8%, they go up every year. Overall, healthcare costs were actually down 1%, something that I've never seen before, so may not happen again. And keep in mind that oil was down 27% in 2023 compared to 2022. And because everything that we make and everything that we eat has massive amounts of oil in it, right? Oil's the driver of the economy. Well, that meant that everything else on this page started to drop, right? Cars, especially electric cars, were down by massive numbers in 2023 compared to 2022. Now, we obsessively tracked inflation throughout the year, sometimes looking at it multiple times a day. And as you can see on the left here, there are two different measures of inflation. So the blue line, it tracks inflation, including food and energy. And this measure, it tends to be more volatile, as you can see from the graph. So it peaked slightly, it's slightly over 9%, 9.2% in June 2022, so about a year and a half ago, and it's now down to about 3.1%. The inflation readings today came in a little bit higher, but still around that 3%, 3.1% range. The other measure of inflation, which excludes food and energy, it tends to be a lot less volatile. You see there the dotted line. And it peaked at about 6.5% in 2022. And while the graph is showing it at 4%, as of now, it's actually in the threes. Now, what's more important is that recent numbers, with the exception of the report that came in today, if you look at the last 6 months, they've all been phenomenal reductions. Today's numbers were meh. They weren't. There was still a reduction in one of the numbers, and one of the numbers was flat. The market was actually thinking that they would go down, and so the Dow went down 500 points. But overall, the numbers are still in the threes. So we expect that these numbers will continue to come down because the Fed's not in any hurry to cut interest rates. And so the expectation is that for 2024, and you can see on the screen, inflation will be at 2.3%. That's still a little bit higher than pre-COVID COVID. You can see the pre-COVID numbers there. So you sort of average them out there a little bit under 2, but it is not a number that scares anyone. It could have been a lot worse. Inflation may not have come down as smoothly as it has. So I'm just very relieved with where we are with inflation compared to where we could have been. Now, why do we care about inflation as real estate investors? Because high inflation is tied to high interest rates. And those rates are highly influenced by 10-year treasury rates. And that's what the Fed is basically jacking up and down as it does its thing. And I'm really, really happy today as a real estate investor to see this graph because just 5 months ago, on October 17th last year, right here, the 10-year treasury hit 5%, just for a couple of days, but 5%. That is a stunningly high number that no one had projected in 2022 or 2021. But today, the number's around 4%. So it's gone up a little bit, but it's around 4%. So down 100 basis points or 1%, even though interest rates have not been cut in this time frame. So the market's basically projecting the future. That's great. But none of us pays treasury rates when we buy single family homes or we buy multifamily homes. So it is important to look at actual mortgage numbers. And once again, you can see that the 30-year mortgage, and that's this number here, the blue one here, it peaked around that October 17th date that I just told you about at 7.79. That's just a killer, 7.79. And today it's around 6.6. So it's dropped about 1.2% in 5 months. Once again, the market's correcting, and it's correcting in the favor of real estate investors, right? And bottom left, you can see this dude, Sam Cater, he's chief economist at Freddie Mac, and he says lower rates are now bringing potential home buyers who were previously waiting on the sidelines back into the market. So a bunch of people, once the rates went to the 7s, they were not interested. Now that they're down to 6 and they seem to be potentially moving further down, we're beginning to see more homeowners in the marketplace, which is great. Now, none of these potential home buyers are really going to jump into the market unless they feel comfortable about not just inflation, but about their wages, about their salaries, right? Wage growth is how Americans measure their net worth. And for nearly 3 years, inflation was faster than wage growth right here, right? But here on the right side of the graph, you can now see that wage growth in the US, salaries, are growing faster than inflation. And that makes Americans feel good about themselves. And they start buying homes and cars at a faster rate. In fact, most people would be shocked to know that wage growth in the US as of July 2023, about 6, 7 months ago, was over 5% a year. Something that very rarely happens in a developed economy like the US. And that wage growth is cooling now. You'll see some of that in a few slides. You'll see some data, but it's still above inflation. All right. So that was a good look at 2023. So it's time for section 2, where we share some economic forecasts for 2024. And remember, these are not real estate forecasts, but most of the real estate forecasting that's in section 3 is based on these critical economic forecasts. Our first prediction today is about the economy. And I have to start by saying we were wrong last year. Last year, when we did this, we thought a recession was inevitable. But today, based on very strong evidence, we are forced to change our mind. We think that the US economy is going to have a soft landing this year, even though the second half of this year is going to feel like a recession. So this is Marcus and Millichap's prediction of what they think is going to happen to GDP in 2024. So you can see 1.2% is what they're looking for. And we've studied a lot of predictions. We don't have time to show you all of them, but they're all pretty close to this much. This one, basically, they're saying, yeah, the economy might grow at, 1.2%, 1.5%. But every single one of these forecasts at this point is saying the soft landing is likely to occur. So our first prediction, the US achieves a soft landing. And you can see a lot of economists are saying things similar to what Freddie Mac is saying here. So this is representative. As you can see, Sarah Hoffman says that the economy is on track for a soft landing, but will be bumpy throughout the year. It was bumpy today. The Dow went down 500 points. Our prediction on multifamily is about additional strain that is coming from all the new incoming supply of Class A apartments and high interest rates. But she does expect multifamily to retain its numero uno status as a favorable asset class. All right, moving on to number 2. Our second prediction is about the labor market. The Fed is doing its job. And every month, we are seeing job openings go down from their peak. And at their peak, they were at 12 million. You see this peak right here, right? 12 million, and we're about 9 million today. And as you can see from the chart on the right, as these job openings drop, so does wage growth. So wage growth here was about 5.1%. Now we're down to about 3.2%. So healthy, above inflation, always good. But we expect and we predict that wage growth will continue to cool and eventually end up in the 2s or 1% range, right? And one of the things that cools inflation is wage growth. When wage growth is low or negative, inflation is low or negative. Now, our third prediction is about the unemployment rate in the US. And once again, we have to eat humble crow on this one because our prediction a year ago, we had a chart like this a year ago, was that the unemployment rate would be about 4.5% by the end of 2023. And as you can see from the red section on the red, everyone was right on the fact that unemployment would go up, but it went up really, really slowly. I mean, just basically 0.2% throughout the year, right? Analysts do expect that trend to continue and accelerate just a tad bit throughout 2024 and expect unemployment to end 2024 at about 4.3%. So we're at 3.7 now. They expect it to go up a little more than half a point. Now, keep in mind, this, which is the peak, is still extremely low levels of unemployment, right? I do expect after that in 2025 for unemployment to trend downwards, potentially ending 2025 at under 4%. Right? So that's the prediction for unemployment. Let's move on to prediction number 4, which is about the growth of the economy, commonly referred to as GDP. Now, as you can see from this section on the red, growth did impossible things in 2023 because it pretty much accelerated throughout the year as the Fed was pounding it with this massive interest rate hammer. Now, of course, a lot of those more recent interest rate hikes are starting to take effect. So they're starting to take effect in Q1 and Q2. So the analysts do expect the economy to slow down quite a bit in 2024, with the second half, which is right here, feeling like a recession. Remember, if it goes any lower than 0 for 2 quarters, that's a US recession. We don't think that's going to happen. It's going to feel like a recession. And then really, to start to accelerate in 2025 and accelerate throughout the year in 2025. 2024 is also an election year, and it's normal for the economy to accelerate immediately following an election. All right, number 5, our fifth and final prediction in this economy section is about interest rates. As you can see from the screen, analysts, they're ridiculously over the map, right? So there's you can either look on the left where Wells Fargo is like the Fed's going to go crazy and cut 200 basis points. That's ridiculous. And then on the right side, Barclays like, no, they might only do 50 to 75 basis points. That also, I think, is a little bit too gloom and doom. I think the average on this page is about 130 basis points, which is 1.3%. We think that the market's overshooting. We don't think that the Fed feels like they need to raise rates that quickly. So our feeling is that we're going to see 100 basis point raise this year starting in May. There's no meeting in April, and March doesn't look likely. The Fed seems to have time, especially with today's inflation numbers. So we think that they're going to cut a quarter point in May and then basically cut at several other meetings throughout the year, ending up with 100 basis point or 1% lower in mortgage rates. All right. So we're done with the dense economic analysis stuff, and now it's time for something more interesting, which is real estate. We're going to do a quick 2023 flashback, and then we'll get to the business of forecasting single-family and multifamily performance in 2024. So I'm going to start this journey with single-family prices. I always like to look at single-family first because single-families are a much larger market than multifamily. And single-family prices affect multifamily prices, affect multifamily rents more than anything else. And I'm going to start by saying the following words. The biggest disruptive trend you will take away from this presentation is single-family prices are in a bubble. But this is one resilient bubble. All predictions that single-family prices will decline in 2023 turned out to be wrong. Last year, I showed you a chart of 21 different analysts, with CoStar being the most bearish at negative 20%, and the Brokers Association, the NAR, National Association of Realtors, being the most bullish at 2 or 3%. Usually the NAR is wrong most of the time. In this case, they were right because home prices did not go down. Home prices went up, right? They went up a couple percent. So not a huge number, but they went up a couple percent. Now, so why do I consider single family to be in a bubble if it's only going up by 2%? Well, for that, you only have to look at the three numbers on the right? I want to ask you to look at this number. Mortgage payments since COVID, since Q1 2022, have now gone up 111%. That's a shocking number. I want to point out that salaries in the US have gone up by 19.7%. 111% increase in your mortgage, 19.7% increase in your salaries. Now, of that 111%, roughly 38% came because prices went up, right? Prices have been going up since COVID every single year. The rest of it came because interest rates roughly doubled. Well, if all of this stuff happens, you tell me with these three numbers completely out of whack with salaries, why shouldn't home prices go down? Well, because it's a bubble and it's a resilient bubble, right? And I know that there's a lot of single family fanboys in this audience that are typing right now. They're thinking, Neal, you're wrong because interest rates are going to go down. They're going to be much lower in 2024. So home prices really aren't a bubble. Okay, fine. Let's look at those mortgage rate predictions for 2024. Here they are. These don't look low to me. Even if we pick the most bullish projection on this page, that's the green one from the Mortgage Bankers Association, they think rates are going to be 6.1%. Why? Because rates are predictive. They've already gone down quite a bit. So they can't really go down unless the Fed cuts aggressively. So we're at 6.7 now. They think it's going to be at 6.1. Well, they're predictive. I don't see them going down much. So I think these numbers are right. So bottom line is these are very, very high interest rates. Wouldn't that make the bubble burst? No, it won't. Because despite those astonishingly high interest rates, almost nobody in the marketplace that we can find is predicting a decline in home prices this year. Even the two red bars on the page from Realtor and Zillow on the left barely move the needle, right? One of them is minus 0.2, minus 0.1.7. That's not really a decline. I mean, it's just rounding errors. Why? Because everyone's pointing out that there's low unemployment, there's high wage growth, and more than 9 million jobs are open in the US. So no one's predicting that the housing bubble is going to burst this year. And all of them are pointing out that this is because of a unique factor called the lock-in effect. So let's study the lock-in effect. Let's say you're a homeowner, right? So you purchased your home 5 or 6 years ago. It's been appreciating every single year. And right now it's worth about $1.2 million. That's my example. This California example, right? And you have about $350,000 of equity, home equity that you built into your house. So a couple of years ago, 2021, you refinanced, you got a great rate, 3%. And that's going to put your monthly mortgage payment right around $3,600 principal and interest. And then you find out your wife is pregnant and you're going to need an extra bedroom. So today in 2024, you go check out properties, you see homes with that extra bedroom are now going to be 1.5 million, right? And you crunch the numbers and you have about 350K in equity that you can take from the sale of your current property and apply it towards the down payment. So that's awesome. But with rates around 6.6%, here's what you realize. Even with $350,000 down through that equity buildup, your new multi-payment is $4,000 a month higher at $7,600. That's nuts. Who can afford that? And this is the reason why we are seeing a massive number of homeowners, tens of millions of them, having to stay on the sidelines because payments just don't make sense anymore. And that lock-in effect means that the housing bubble is unlikely to burst and maybe not even deflate for a number of years. There's very little inventory in the marketplace. And that ridiculously small amount of inventory is leading to a new phenomenon. This is known as forever renters. And this is our second disruptive trend, forever renters. Now, it used to be that 2/3 of Americans lived in their own home and about 1/3 lived in a rental property of some sort. But with these astonishingly high prices, astonishingly high mortgage rates, and that lock-in effect, we are now seeing middle-class Americans become forever renters, an entire generation, right? You can see from this graph that buyers today, and you see the big spike here, this is COVID, right? So see this massive spike here in the last 3 years. Buyers must now earn $115,000 a year to afford a typical home in the US. And that typical buyer doesn't make $150,000. They make 75K in 2022. So let's call it $80,000 today. So that's a $35,000 gap that's almost impossible to bridge today or even in the near term, not even in the next 5 years. And remember that 115K number that I just gave you, that's for the whole US, right? Let's look at some of the cities that have high job prospects where people have lots of jobs, expensive jobs, and see what the numbers are like there. In San Francisco, you need a median income of $404,000 to afford a home. And even though San Francisco prices have gone down this year, the doubling of mortgage rates meant that this 404,000 number that you see here, it is up by $100,000 in a single year. And in case you're thinking, Neal, why would I go live in San Francisco? I can go to Phoenix. Well, is Phoenix cheap anymore? Is Phoenix cheap? It's $121,000. And markets around the US that were considered cheap before COVID are also around or over 100,000. Dallas, 116K. Miami, 145K. Nashville, 124K, right? Austin, 125K. In fact, the only large metros that are near $100,000 now are Houston at 92,000, Atlanta at 107. That's it, just two. And that is what is driving people to third tier cities. So we are now seeing an amazing phenomenon where people are moving from Nashville to Knoxville, Chattanooga, Memphis. People are moving from Phoenix, not just to Tucson, but they're moving from Tucson to Flagstaff. As technology allows smaller and smaller metros to take a bigger and bigger portion of the job, this migration to smaller cities will continue to accelerate because these numbers are just absolutely freaking insane. People not only are forever renters, well, to be forever renters, to actually be able to afford some of their rent, potentially, they need to move to smaller metros. Or if they want to buy a starter home, they need to move to a smaller metro. And I'm not talking about second tier metros that people have moved to in the last 10 years. I'm not talking about third tier metros. And here's an example of how these phenomenon, the forever renter phenomenon, the third tier metro phenomenon, is changing the winners and losers in the United States, right? So the biggest winners since COVID hit in terms of states, you'd think would be, Arizona, Florida, Texas, the cheap markets. Well, would it shock you to learn that Texas is no longer in the top 10 since COVID, right? Because Texas markets are not cheap. 115K for Dallas, Houston at 92, Austin at 126. Texas is no longer ultra hot for home price growth, though it remains a top market in the nation for people to move to. We are seeing new winners. States that you see on the screen like Montana, Idaho, North Carolina, Tennessee. These are the states we're watching when we're looking at creating profits for our investors. So that, in a nutshell, was our roundup of the single family market in the United States and all the disruptive trends that are changing the way we do single family in the US. Now, time for a quick look at multifamily, because a bunch of you guys are multifamily people. Let's take a look at what's happening in the multifamily marketplace. And the multifamily market is in an incredibly balanced place. Now, I generally don't say anything like that for the multifamily market. I tend to consider it expensive, but I want to show you some fantastically interesting numbers. Most people at conferences, they stand up and they say multifamily is still too expensive. And they're probably right. But do you know what a renter cares about? They care about rents. And here, the multifamily market has shown an astonishing sense of balance. Now, I want you to look at these top two numbers on the top right in green. Now, rents have increased 19.6% since COVID. In the last year, it was about 1%. So they were going up like crazy, and then now they slowed, right? 19.6% since COVID. Now, how much have wages in the United States increased by? 19.7%. So you notice that rents are actually going up at the exact same pace as wages, the exact same. There is no better example of the balance in the multifamily market than those two numbers. Since COVID, multifamily rents have only increased by $385. $385. You see that number here, right? Now, mortgages have increased by a stunning $1,140. That's 3 times as high as rents. Don't believe me? Move your eyes here. Watch this. 1023, 2162, the difference, $1,140. More than double. That's where we are. So the fact that the multifamily market is not doing what the crazy crap that's happening in the single family market is the good news. There's balance. Rents are increasing exactly at the same speed as wages. But that's where the good news ends because there's a ton of bad news. And that is massive incoming supply and over 3,000 properties in distress in the multifamily market. Let's dig into those. First, the incoming supply of new apartments. I mean, it's stunningly high. Not since this dude was president of the US in the 70s has America seen this many apartments coming online as we're going to see in 2024. RealPage predicts that there are going to be 672,000 apartments delivered in 2024. That is an absolutely crazy number. And it's definitely more than we can absorb in a single year. Now, it's super important to understand that the vast majority of the supply is in Sunbelt markets, Austin and Raleigh and Nashville and Jacksonville and Charlotte. Those are the markets that are likely to be more impacted in 2024, not the entire national market. Now, some of you may be wondering, or you've said it on social media and you think it's the truth. Neal, there's a slowdown in the single family construction market, and that's going to help us with absorption for multifamily. Yeah. Nobody's building single family anymore. It's too expensive. Neal, we need more apartments. Short answer is you're wrong. This is what's happening in the single family market. A bunch of analysts made predictions a year and a half ago, that we might see stunning drops in single family new construction. None of it has happened. The large builders, they have not seen significant declines in their pricing, though they're heavily using incentives to push their sales. So they're basically shrinking their profit margins using incentives, but they're keeping the prices about the same. And as you can see from this graph, they're currently scheduled to build almost 1 million homes, 976K this year. So we're not seeing a very significant decline in new construction on the single family side. So that's really unlikely to help multifamily this year. And this new supply that I just mentioned, it's not spread around the US smoothly, right? So you've got the Sun Belt that's in this yellow color here, right? It's got a very significant amount of new inventory coming in. So 3% of its total existing inventory is coming in a single year. And it's projected that Sun Belt markets will see negative or flat rent growth. You see that right here, right? Now, you can clearly see the Northwest, which is in green, has only 1.3% inventory. So because of that, its rent growth should be pretty strong at 2.6%. The same thing applies for the Midwest. Low inventory coming in, rent growth about the same. So these are the two areas that will do really, really well. The West is a weird market, right? It's the only market where rent growth is expected to be negative, even though the inventory coming in is low. Why? The West is suffering a great deal from interest rates because they have the highest prices in the country. And the higher the prices, the more sensitive you are to interest rates. So that level of sensitivity is very high. And that's why we're seeing rent growth be a challenge. All right. So now let's look at some rent growth projections for all you multifamily guys out there from three different high quality sources. Yardi Matrix, well, they're fairly bearish. They think that rent growth for 2024 is going to be under 1% here in blue, right? So 1.6 for 2023, okay, not good growth, not bad growth. But here in 2024, they think that we're going to be at 0.8 because they think that the incoming supply is going to take the entire year to get absorbed before we start seeing 3 to 4% rent growth in 2025. So that's Yardi Matrix. CoStar, on the other hand, is more bullish in that they think that the slow period of rent growth, the sub 1% rent growth, is only going to happen in the first quarter of this year. And then they see a sharp acceleration in rent growth, which you can see in these areas. So low rent growth in Q1, low rent growth in Q2, and then a sharp acceleration in Q3, Q4. And obviously, I'm hoping that CoStar is right and Yardi Matrix is wrong. The third source is Marker. And they're even more aggressive in that they're projecting rent growth for the entire year will be 3.9%. Now, for those of you that don't know what this 3.9% means, we'll all be delighted if marker was right and 3.9% was the number at the end of the year. I tend to have more faith in, Yardi Matrix and CoStar. But it's nice to see that someone's predicting rent growth in this year in the 4% range. Freddie Mac, second largest lender in the US, expects that we are going to see good income growth in certain interesting markets. I've shown you this graph before in prior years, and it's never had Oklahoma City or anything in Oklahoma in there. You notice number one is Oklahoma City, number three is Tulsa. And then on the right side, you see the cities with all the big construction pipelines in Nashville, Austin, DC, New York. They will all have higher vacancy and almost no rent growth at all. All right. So that's where we stand with rent growth in the US. So now let's finish the multifamily section with the keyword, one of the big trends, and that is distress, right? So this is the sword that's looming all over our heads, right? Yes, there is distress in multifamily, but let's try and understand this distress instead of just throwing it around. So many of you may have read clickbait articles on the web about $1 trillion in multifamily debt needing to mature. Ooh, scary, right? What most people don't tell you is that this $1 trillion number, which is on the screen, is by 2028. Interest rates are expected to come down this year, expected to come down next year. So if someone's looking to refinance in 27, 26, or 28, it's less of an issue, much less of an issue than it is this year. And by the way, this $1 trillion number offers zero indication of the percentage of these assets that actually might face any level of distress or any level of discomfort whenever they refinance. So this is just the base number, $1 trillion. But people are using it to scare you, so you click on articles. Now, when I appear on podcasts, I do some mental math there, and I think that I mentioned, I think the total amount of distress is about $90 billion, give or take a bit, in multifamily. Now, here's data. I recently found this from Bloomberg, right? Which mentions on the right about $67 billion of multifamily assets that are potentially troubled. Potentially, right? That's the potential, not necessarily troubled today, right? Now, keep in mind, this is a very small portion of the overall multifamily market because the overall multifamily market is $4 trillion. 67 billion is about 1.5% of the multifamily market that could be in distress. Now, on the left, you see it's not just apartments, right? There's all kinds of commercial real estate, challenges, distress, that is possible. Now, it's very important to distinguish the black bars, like this one, from the blue bars, right? Because the black bars are showing the assets currently in distress, like 34.5 billion in office. And the blue bars are showing assets that could be in distress in the future, depending upon how interest rates go, right? And you notice industrial, because of the Amazon effect, shows almost no assets in distress, but a significant number that could be in distress. In fact, notice that the apartment bar at 8.4 billion is 1/4 of this bar. This is the real distress. This is the area that people are really worried about because this 50 billion could potentially go upwards if more people don't come back to the office in the coming 2 years. So with apartments, there's a lot of potential for distress, $67 billion, but real distress is only about $8 billion. I know that sounds like a big number. I just want to point out to you that $80 billion, which is 10 times this $8 billion number, is 1% of multifamily. Sorry, $40 billion is 1% of multifamily. So this number of 8 billion is 0.2% of the entire multifamily market. It's very important to keep perspective when you're looking at these big numbers because they always look very, very big. Now, even amongst multifamily syndicators, there is this irrational, somewhat nonsensical belief that there's already a large amount of multifamily distress. And this is just BS. Okay. Here you can see the actual delinquency rate by loan category as of Q3 last year. So this is the end of Q3. So only about 4 months ago, right? As you can see, the big bars in terms of delinquency are credit cards, auto loans, then home equity loans, then delinquency in single family homes, and so on and so forth, right? And then eventually you get to offices and things like that. Where is multifamily? Well, it's all the way in the bottom, this bar in green. So once again, as of Q3 last year, only about 0.4% of all multifamily assets in the United States were delinquent. 0.4%. Will it increase? Sure. I think it's going to probably go all the way up to 1%, 1.5% before it starts to decline again. But will it increase anywhere near the levels that you see at the top of this chart? Heck no. There's actually no conceivable scenario that logically could be presented where that actually happens. And let's say it happens. Let's say it happens. It's still going to be restricted to certain markets, right? So this green bar here shows that most markets in the US really don't have much distress exposure, right? Some of the peaks that you see here are Washington, D.C., that's D.C. here, and that's San Francisco. So overall, the markets that are the most exposed, right? So you see these big bars here are basically New York, Dallas, Atlanta, LA, Austin, and San Francisco, which has the highest exposure. I wanted to give you two different sources because there's a lot of argument about this. So here's Bloomberg, right? Their list of cities is slightly different. So once again, they've got New York in there. They still have Los Angeles in there. But now they have Chicago, Dallas, Houston in the top 5 list. Once again, I want you to look at something. Look at the screen. These are some blockbuster mega cities. And even in the biggest city in America, more than 10 million people, the total number of potentially distressed assets, not distressed, but potentially distressed assets, this bar here is about 450 buildings. Do you know how many tens of thousands of buildings New York has for apartments? It's a massive number. This is what I keep saying. These numbers are big. Investors are going to lose money. There's going to be pain. All of that is true. But equating that with distress in the market to the level where prices could crash, there's no mathematical evidence of this. I just keep seeing it on social media, and these days people think social media is actually the truth. So I think this is a good summary. I like this guy's summary. His name's Spencer Gray, founder of Gray Capital. And he says, while the next 6 to 12 months are still uncertain, fair, I can imagine a scenario where we witness some real distress all at once, probably in some markets, which will create a lot of fear. And that may create a window where some incredible assets can be acquired at a significant discount from previous market pricing. Any distress will be short, agree, with the interest rates gradually lowering and the base case for multifamily being as strong as ever. So far, by the way, some of the stuff that he talks about, incredible discounts, hasn't happened in any market in the United States. Might happen in some. So here's my summary. Investors are scared because of what happened in the last 24 months. They're making the exact same mistake that they've already made in 2008. They're doing this exact same thing. I'm not seeing any difference in people's behavior. What I'm seeing today are multifamily assets that are at least 20%. So the multifamily market has now declined 20%, right? That's the new number from all the analysts. Some areas have declined 25, 30. So everything is discounted, 20%, 25, 30%. And all of this is not happening in a weak economy. It's happening in a strong economy. It's happening in an economy where single family is clearly in a bubble. And it's also happening in a market where more and more people are assuming loans. So they're not basically taking on new expensive loans. They're assuming loans that were locked in 2022, 2021. And because they're assuming, they're getting the discount, the 20+% discounts, but they're not having to pay the high interest rates or deal with exposure to interest rates going back up again. It's a tremendous time to be buying multifamily. And the people in the know, they understand this. Take a look at Sharpe ratios. If you don't get Sharpe ratios, you can ignore this slide. That's the Sharpe ratio for multifamily. And on the right side, large cap stocks, corporate bonds, government bonds, small cap stocks, commodities, even commodities, right? So when you're looking at the Sharpe ratio, it still remains the darling of real estate. Now, I don't want to say that this is a low risk investment. Multifamily has always been a significant risk investment, and I don't want to downplay that. But the key that you should understand is that this remains the darling child of institutional investors and the darling child of real estate. All right, time to finish off with the city by city shootout. I know lots of you are here just for that, so let's get started. But before we show you the top cities of this year, let's spend 60 seconds on what Pro Capitis is doing. Um, we are eating our own dog food. We're currently in contract on this property, Midtown Ridge, 193 units in Chattanooga, Tennessee. Value add property, proven upside, terrific high growth market. We love that we can get huge discounts on properties like Midtown, even though we're able to assume a fixed rate loan that's significantly lower than the market rates today. So we get all the benefits of the distress in the discounts, and we don't have to deal with the downside of floating rates or high fixed rates. And we're buying this property at about 37% below our peak offers in 2022. So terrific property. 193 units, was built in 1986, so good bones. Spread across 9 acres, 93% occupancy, and strong effective rents at $1,248. We've actually raised about, Anna, is it fair to say we've raised about 80% of the money for this property already?
A little over than 80%,
Okay.
Neil. So we're
Okay.
well on our way. Yes.
We're in the 80s, right? And what's more important to point out is that even if a property appraises for 1 or 2 millions more than when the property goes into contract, whatever the purchase price is, people are really happy about that. This property appraised for $7 million more than the purchase price 5 months ago. $7 million more. The appraisal was 36.6 million, and that was after all of the rate hikes were done, right? So after that appraisal was post every single rate hike, right? And it was appraised at 36.6 million. We're buying it at 29.6. Discounts are a wonderful thing. That's what it looks like. Very nice, good shape, good bones. And we are projecting that investors investing 125 grand are going to come in at a 20% annualized return and a 2x equity multiple on this. For those of you that this is not your cup of tea, I would love for you to ask me about Mission 10K. It is our mission to build 10,000 townhomes. Think of it as my personal life mission, and it's an incredible mission. There's massive value. Build to rent is unquestionably going to be one of the biggest trends in real estate for the next 10 years. Why? Because those 20 million families that I mentioned that are between that 75K in income, the 115, they don't want to live in an apartment. They have good incomes. Before COVID, these people would be buying their own homes. Today, they don't have a chance of doing that. They want to live in something like a home. And that something like a home is a rental new construction townhome. So that's our mission, to build 10,000 of those. We need your help. We need your assistance. We need your oomph on Mission 10K. So ask us more about that, and we'll be telling you more about it in coming months. Time to finish up with the shootout. I like to start with U-Haul. Texas and Florida retain their number 1, number 2 ranks for the states with the highest number of people moving. Number 3, number 4 were also similar compared to last year. So North Carolina moves up a spot, South Carolina moves down a spot, Tennessee moves up a bit, Idaho moves down a bit. New entry on the chart, so Washington State moving up from 23rd to 7th. But otherwise, Arizona, Colorado are right about where they were a year ago. Biggest losers are the same, Massachusetts and California. Notice that California has been the biggest loser 4 years in a row. Now, keep in mind, Texas is number 1, but its price growth for single family is now outside the top 10 because it's becoming a more expensive state. All right, done with states. Let's move on to top cities. Never in my life did I think I would see a city in Ohio at the top of the top 10 housing market lists. And never in my never in my life did I think I'd see a list that didn't have a single city in the Southwest, right? This is Realtor.com's top 10 housing markets for 2024, completely skipped the Southwest. So you've got, Midwest, Northeast, some of the cheaper cities in the West like Bakersfield. The trend is clear. The top boom towns for the moment are not doing well because of high interest rates. Now I want to balance out that Realtor.com list that was a little hard with this second list from Zillow, a little more balanced. But once again, the state of Ohio rules. Number 2, number 3, number 8 are the top 3 cities in Ohio, right? So you got Cincinnati, Columbus, and Cleveland. Amazing, right? Zillow has sort of a more balanced approach. So you do see some boom towns in the list. So you see Atlanta, which was our city of the year last year, Charlotte, which was our city of the year in 2020, Orlando, and also Tampa, which was our up and coming city in 2022. So all of the cities that we've been talking about in the last 3 years are here. It's also nice to see Indianapolis in the list because that was our
Yeah.
up and coming city 2 years ago. Another list. This is from Realtor magazine. Sorry, this is from Spinks. So they are giving the nod to some interesting future boomtowns. I want you to pay attention to number 2, Grand
Yeah.
Rapids, Michigan. Also pay attention to Myrtle Beach, which is interesting that it's becoming more of a boomtown in South Carolina. So there's some very interesting stuff here. Pittsburgh, which is a perennial non-performer, is finally beginning to live up to its potential. Also, a city that I think is going to do really well is Knoxville, Tennessee. This is a very interesting list. I really enjoyed this list. Marker is basically trying to figure out what city is likely to become the next Austin, right? In their mind, it's Raleigh, Durham, North Carolina. We picked it as joint city of the year in 2020. Provo, Utah, we picked it in 2016 and 2017 twice. There are only 2 cities that we picked twice. Madison, Wisconsin, a nice up and coming city. Kansas City, it's great to see that. We picked it as an up and coming city all the way back in 2019. And then we have Colorado Springs. So not sure about Colorado Springs just yet. We want to see more of it. But the other 4 are very interesting cities. If you're interested in, figuring out what cities is going to be the next Austin, it's probably going to be one of those top 4. All right, Anna, I'm done with the analysts. It's time for me to stick out my neck. So the best up and coming market in the United States is going to be Grand Rapids, Michigan. Now, last year at this time, we mentioned Grand Rapids as a near miss. It lost this category to Jacksonville. This year, it finally gets its time in the limelight. You saw it multiple times in our presentation today. Very strong value index. It's got great cost of living. It's got a great downtown, very interesting bougie neighborhoods. So great value. Now, keep in mind that this year, home prices were down in a lot of the Southeast markets. They were up only about 2%, but Grand Rapids was up a shocking 12.8% in 2023. And the best market in the United States is our 2020 joint winner. It is Raleigh-Durham. This time it's back on its own. In my mind, what differentiates Raleigh from so many other boomtowns in Texas and Florida is the exceptional quality of its talent. And that is why it showed up at the top of that list that we just saw of potential future Austins. To be a potential future Austin, you need an incredible amount of talent. And Raleigh has 3 world-class universities that are anchoring this market. And because of that continued supply for talent, even though Raleigh had a massive amount of new construction delivery this year, it was different from all of the Texas and Florida markets. Its rents continued to rise. The demand is amazing. I do expect the market to slow down in 2024, has another huge set of delivery coming in. But beyond 2024, I think this is a phenomenal 5 to 7 year market. So if you're investing in Raleigh-Durham, you should be incredibly well served. So those are all of our trends and all of our top cities for 2024. That's our presentation. We do a dozen of these presentations every year, sometimes more. And we'd love you to keep coming back to Multifamily U. If you're already subscribed to our list, that works. Please do answer the poll. It really, really helps us. And if you're not interested in some of our projects, then it really helps us stay away from you and not bother you. So please do answer those, and we will start taking questions. It's okay to ask questions about any city in the US. Also okay to ask questions about any trend that I didn't cover.
However, it is not okay to ask questions in the chat box. If you would like your question to potentially be answered, hopefully we can get through it, it needs to be in the Q&A box, please, not the chat box. Are you ready?
Yep, I'm ready. Bring it on.
All right. Well, let's just start with what are your thoughts on Columbus, Ohio?
Phenomenal. I think that Columbus, Ohio was, if I had to pick a second city beyond Raleigh, North Carolina, that I would have picked for city of the year, not maybe up and coming city. We have, by the way, picked Columbus, Ohio as up and coming city before. It's been a while. I would have picked Columbus, Ohio. So I was tempted to pick Columbus. There's a lot of phenomenal things going on there. As you saw, it was in the list, and I think it might have been in the list twice. Great city. terrific stuff going on there, even though I think that that Intel plant, that $40 billion plant, is going to take a lot longer because of the slowdown in chip design. But I still think it's a phenomenal city to invest in.
Do you think that the inverted yield curve will lead to a housing or multifamily housing downturn?
If it was going to do that, it would have done so already. We're on the downslope of interest rates. So at this point, inverted yield curves don't matter as much as they did 12 months ago, no? Maybe my understanding of yield curves is not good, but my understanding is the threat from the yield curve was 12 months ago.
What do you think about property for short-term rental in 2024? Is 2024 a good time to enter the short-term rental market as an investor?
I think it's a bad time to enter because the short-term rental market, the pricing is based on single-family pricing. And I showed you that the single-family market is in a bubble, which by definition means that the short-term rental market is in a bubble. Doesn't mean that it's not a profitable market, but you don't really want to typically buy at the top of any market. I think there's the possibility that we could see some price declines in single family, perhaps not this year because the economy is recovering and interest rates are going down, but in the future. There's also the possibility we might just see it plateau for about 4 or 5 years. Either one of those two cases, I probably wouldn't be rushing out to buy a lot of short-term rentals.
I would just add on to that some people that got into the short-term rental market in 2021, 2022, because it was such a hot thing, they're now seeing a major downturn and losing money. So
Yep.
there could be discounted buying for short-term rental if you're buying a turnkey short-term rental. So be on the lookout for a discount for distressed owners. But other than that, I would agree with Neal. Are San Francisco prices a bubble because no one will sell if they have a low rate mortgage and would have to trade into high rate mortgage? In other words, low supply?
No, we're seeing San Francisco prices for single family come down. We're also seeing multifamily prices come down. I think San Francisco is overvalued, and it's as much of a bubble in single family as any other market in the US. Having said that, after 8 years of making predictions about California, I've learned a few things. I live here. This market, because of its extraordinarily unique benefits, there's no other market like it in the US, does appear to have some kind of floor on it. So I'm not predicting gloom doom for San Francisco. I just think it's a terrible time to buy, and the market could easily decline another 5 or 6%.
Could this rate drop kick up a refinance trend this year?
Very unlikely. I think that a lot of the people that needed to refinance had plenty of time in 2020, 2021, 2022. So there's going to be refinancing happens if rates fall into the fives, but I don't expect them to be in the fives this year. So maybe if you asked me the question about 2025, I would have said yes, but for 2024, I'm going to say no.
What are your thoughts on build to rent?
I think it's an incredible market because of the slide that I showed you. I'm going to basically throw that slide up again, right? BTR was temporarily affected significantly for us and for everybody else because of the high interest rates, high construction costs. Things are beginning to balance out now. The key with BTR is this. For the first time in American history, middle-class people cannot afford to buy homes. This has never happened before. And because it's happening, and because it's happening to such a large number of people, right? These people that make 65K, 75K, 85, 95K. I know those sound like low numbers in California, and a lot of you are Californian, but outside of the big markets, right? 65, 75, 85, 95 are all good numbers. These are middle class Americans, and there's tens of millions of these families. None of them can afford to buy a home, and none of them want to live in apartments, especially if they have multiple kids or pets. And so BTR is likely to become about 10% of the apartment market. We build 400,000 apartments a year. Not this year, we're building a lot more, but most years we build 400,000. So I think that there's room for between 40,000 and 60,000 built to rent units as a permanent part of that apartment allocation.
Do you see previous hot rental markets, Austin, Phoenix, Florida, North Carolina, do you see them bouncing back?
Not in 2024, because those markets still have massive amounts of inventory coming in 2024. So Austin has the largest. Phoenix is not much further behind. There's Phoenix's inventory was a little bit front loaded, so I think that it might do a little better than Austin, but not a lot better. So I think what I'll say is this, with possible exceptions of Raleigh, I think most boom towns will have negative rent growth as a group. Some might be flat. I don't expect any to be positive.
How will storage units and RV parks perform compared to multifamily?
I think RV parks will perform really well. They're a small asset class. It's very difficult to get new zoning approved for RV parks. Most people are opposed to it. There's more and more NIMBYism about RV parks. And that means that there's just not a lot of new inventory. There's a lot of new multifamily inventory, and that's affecting rents. But there's just not a lot of new RV park inventory. And so it's a terrific asset class. It's not scalable. So a lot of investors like me don't touch it because a lot of RV parks are pretty small, 2 million, 3 million, $5 million parks. And so that in a mom and sort pop sort of way makes it a better opportunity than multifamily for those of you that can sort of live within those smaller numbers. I like to buy $30 million property, so I don't really have choices in the RV park arena. So I think it's a great asset class. Now, self-storage is a different story. Self-storage hasn't declined much, and I understand why. So here's what I'll say. There's this concept that self-storage doesn't decline in recessions, it doesn't decline when interest rates go up. My study indicates that it's not true. It just tends to be more smooth, right? So multifamily, 20% drop, right? Office, more than 20% drop. What self-storage tends to do is, firstly, when it declines, it tends to decline a little bit later. So it tends to decline 6 to 12 months later. And then when it goes down a little bit. So here's my prediction. I think self-storage is going to do quite well. But having said that, I think prices for self-storage need to decline by 5 to 10% this year. So maybe wait until they go down 10%. That should happen in the next year.
Will the real estate market, especially the office sector, delinquency rate create a tsunami which will hit the banking system?
Yeah, possibly. I think that so. I've done a lot of research into the potential impact of the banking sector because of the office market. The numbers don't add up for any kind of contagion in the banking sector. They add up to significant numbers of banks going out of business. So I'll just say 2024, a significant number of mid-sized banks in the United States will go out of business. The numbers are not large enough to cause contagion.
Do you think single family bubble will burst? And if so, when?
No, I don't think so. I think we might see single family sort of just, muddle along for a number of years. Inflation is 2.5%. So if single family doesn't go up, then it's really going down, right? Because in a normal year, if you look at the last 50 or 100 years, single family price growth tends to be a little bit above inflation. So if inflation is 2%, then it tends to be 3. Well, if it's going to be 0, then it's really losing 3 basis points. And in that sense, it's still slowly deflating. So I expect single family prices in the US to basically be going up slower than inflation for the next 3 to 4 years. I'm not sure if they're going to significantly deflate.
Neal, I am going to start firing at you cities. So people have been asking about cities, some, phrase it this way in a sentence, some phrase it that way. So to my audience, I'm going to try to get the most different cities in there by simply asking your city name, because in general, you want to know about your city, however you phrase your sentence. So let me go here. San Antonio.
Good city, benefiting from the return of manufacturing to Mexico. Manufacturing is not coming back to the US, it's coming back to Mexico. In the short term, though, significant supply. I don't expect rents to be anything other than flat in 2024. So I expect prices to drop maybe 5 to 10% in 2024.
New Braunfels, Texas.
It is seeing some price drops. It's seeing some rent drops, but not as much as San Antonio. Bougie markets like New Braunfels do better than the host market, which is San Antonio. But I expect that both markets are going to take a hit this year.
Sacramento for multifamily?
Sac's an interesting case. It's very hard to predict what happens with Sacramento. It doesn't necessarily follow the San Francisco Bay Area. I'll say flat.
Virginia Beach slash Tidewater areas.
Not a market that I take a look at. A lot of the Northeast markets we don't look at because they're steady eddies.
Richmond, Virginia.
Another steady eddy market should do fine.
Houston, Texas.
Houston is going to take a hit from incoming inventory on the single families, on the multifamily side. On the single family side, Houston's in an interesting position. It is now the only above 4 million population metro in the US that's below 100,000 for median household income. So I expect that Houston will continue to grow on the single family side, and I think there's some ability to prices for prices to go up. But on the multifamily side, there's too much supply coming in, so flat to slightly negative.
Arkansas market?
Incredible. You cannot go
Is that for
wrong
single family?
with for anything. I mean, Northwest Arkansas is absolutely incredible, sort of top pick for small market in the US. We were tempted to pick it above Grand Rapids, Michigan, but Grand Rapids has been just doing incredibly well for 3 or 4 years, so it was time to pick it. Now, other parts of Arkansas, I'm not so sure. Round Rock looks interesting.
Cleveland, Ohio, especially for short-term rental purposes.
I don't think it's a great short-term rental market. I think that it is a decent cash flow market. It's well priced, but I hesitate to recommend markets that lose population.
Phoenix and Tucson.
Phoenix is an incredible market. It's just not a great market for multifamily right now because of the incoming inventory. But I would be very interested in picking up bargains in Phoenix at the end of this year. Tucson, be a little careful about because it sort of became overpriced. I was part of that process. We bought a property for 55 grand. We sold it for 183 a door. So I think prices there are pretty high. So be careful of Tucson at the moment.
Oklahoma City.
Amazing place. I think you'll do really well with multifamily. Rent growth is expected to be sharply positive in 2024. So I think it's a strong market. You just have to be a little careful where you're buying in Oklahoma City because there's a lot of sketchy areas.
Tulsa.
Almost the same, but I'd say, if you want to pick one out of the two, you'd probably pick Oklahoma City over Tulsa.
Jacksonville, Florida.
Lot of new inventory coming in Jacksonville. Market's been doing well, but I expect rent growth to be flat. On the single family side, it's still cheaper than Orlando, cheaper than Tampa, cheaper than Miami. So I think it will continue to do well on the single family side.
Multifamily in Charlottesville, Virginia.
Don't know enough.
Upstate market of South Carolina. I think that's Myrtle Beach and,
Well, yeah, I mean, I'm not sure what that means. So ask your question again, be specific.
Yeah, isolate, please. We're not that familiar with upstate market, upstate. Jersey City, New Jersey for multifamily apartment building.
I think it's decent. My big question is this. New Jersey is getting left behind because of all the crazy stuff that they do. They're ridiculously high property taxes. I think what's happening over time is investors are shy now of investing in states with massive property taxes because they've been hit so hard in Texas. So I think there's a negative connotation to New Jersey, which has one of the highest property taxes in the nation.
Ocala, Florida, south of the Villages.
It's an interesting market actually because of where it's located, right? So it's very close to Lakeland. It's close to the Villages itself. I think that area is doing well. Not a lot of room for single family because it's gone up a lot, but I think that there's potentially some room there for multifamily. Though I don't think of Ocala as being south of Villages. I think of it sort of being closer to Tampa. Maybe my map is not functioning right now.
Des Moines, Iowa.
It's a very interesting market. Des Moines is a market that I think has potential. Just be careful of your real estate taxes in these markets. Also, the last time I looked at Des Moines, it had very high expense ratios, if you know what that means. So check expense ratios.
Miami.
Yeah, Miami, I will tell you this. Every time I say something about Miami, it turns out to be wrong. So I'm just not going to say anything about Miami. This market It's like,
Keep saying
so
it.
you want me to maintain my perfect track record of being wrong
I
about
do,
Miami
because
all the
that's
time?
where I live, brother.
Look, Miami makes no sense. It makes no sense, but there's so many ridiculously rich people moving there and buying $1 million, $10 million, and $100 million homes that Miami seems to be in some sort of crazy transition. And so even though all kinds of make no sense crap is happening there, it's continuing to do well. By all means, it should crash, but nothing happens.
Nope, not happening. Fort Wayne, Indiana.
Terrific market. I think you should keep an eye on it. If you're not looking to invest in Indianapolis, you should look at Fort Wayne.
Charleston, South Carolina.
Also a terrific market. In fact, all the way from Charleston to Myrtle Beach, that entire corridor, I think it's about 2 hours long along the beach, is a interesting place to expand. Not necessarily if you were, live in California, but if you live in South Carolina, certainly look at.
Memphis, Tennessee.
What I would like to say is that there's a lot of good markets in Tennessee. There's Nashville, which is the number one market. There's Knoxville. There's a Chattanooga. Memphis is really fourth on my list. Why would you want to go to a market that's fourth on a list?
Albuquerque, New Mexico.
Good market, also Santa Fe. I think Albuquerque and Santa Fe are going to start showing up in our lists more. We are already seeing them show up a lot more. So here's what I'll predict. Either Albuquerque or Santa Fe are going to be in some of our lists next year.
What secondary or tertiary markets are good near Atlanta for multifamily?
Augusta.
Detroit, Michigan, and surrounding suburbs.
No for Detroit. Yes for surrounding suburbs. I think Detroit has some amazing suburbs now, and I think that there's significant cash flow potential.
Okay, we're going to stop on the cities for a while and go back to non-city questions.
Sure.
Let's see. One of the first slides showed GDP for various countries, with US being the best. Where is China in this?
We don't usually show China in developed countries. We show India and China in developing countries. China's growth is about 5%, which is amazing compared to the US's 2.1%, but it's actually really poor for China because their average has been around 7% for the last 2 decades. India, of course, is the big country of the 21st century, and India's growth continues to accelerate. Its stock market continues to accelerate. So the story of China is, because of the worst demographics in the world, they are slowing and slowing rapidly. India, because of some of the best demographics in the world, is accelerating wildly.
What do you think about the rise of insurance rates, especially in certain markets?
Well, Florida is concerning. So I think if you're underwriting in Florida, go ahead, buy properties, but give yourself a big buffer for insurance because it's somewhat of a X factor. I think that for now, most of the insurance hikes are done. They sort of go in waves, and the last wave is hit. But there's just no understanding of what the weather is going to do next, right? There's this feeling that climate change is not real. Well, please ask anyone in the insurance industry if that's the case.
Due to the lock-in rate, do you see an increase of rent-back deals becoming more popular so the owner can get out their appreciated equity and then rent their home?
Possibly, but those are sort of niche plays, right? You're not going to see, millions of people doing it.
How much longer before you see an impact from baby boomers putting their homes on the market?
It's sort of delayed because of a bunch of things, because of COVID. We are seeing some of those homes come into the marketplace, but the inventory is so tight because of the lock-in effect that we haven't seen an impact from it. So I'll say within the next 3 or 4 years, you should start to see the market loosening up because they're selling their homes.
Where in the cycle are we with regards to the multifamily discount prices? Is purchasing multifamily at a discount ending soon?
No, I think multifamily gets further discounted. It's at 20% nationwide discount compared to peak now. I think the market bottoms out in Q4. I would speculate around 26, 27% discount.
What style of BTR do you prefer? In Columbus, there are single families as well as duplexes with low density, 6 to 8 duplexes per acre. What is the density and style of build to rent that you are most building or wanting to build?
So the percentage of build to rent that are single family is sharply declining, and the percentage of townhomes is sharply increasing.
Okay.
Because of cost.
Okay, let's see. Have you considered prefab housing for Mission 10K? This might help control the dollars per square foot.
Yes, it's a very popular thing for people to ask me. It's almost impossible to do it because prefab, the factory has to be within a 100-mile radius because otherwise your cost of transportation eats up all of your savings.
Where are you building the Mission 10K townhomes?
Go to mission10k.com and find out. We publish the cities.
Mission 10K, MISSION 10K.com.
I'm gonna
Let's see.
running out of juice on my headset, so I'm gonna turn the other one on. Keep going.
Okay, yes, some people. I'm going back through all these city names. What book have you read recently that will give interest to real estate investors?
Traction. You know, a lot of you have sort of done the initial work for your companies, and Traction basically is an interesting book that takes you to the next level.
General question, how far out from these cities are you willing to go to invest? Most investable areas by these seem to be 30 to 45 minutes outside.
I think that's a fair assessment. So 30 minutes is good. So like, for example, Lake Forest is 30 minutes from Raleigh, and I'm interested in it.
Are you seeing opportunities in buying distressed office for adaptive reuse into multifamily, especially in your city of San Francisco?
The short answer is no, and I discourage anyone from doing it. Adaptive reuse is extraordinarily difficult and extraordinarily risky. Please don't do it.
What will be the impact of delinquency of credit card debts and auto loans? Will it impact the Fed's decision?
The overall delinquency in credit cards may seem to be higher than the last 2 years ago, but it's much lower than 2008, much lower than 2007. Everyone's concerned about it, but keep in mind that over the last 2 or 3 years, inflation has been higher and wage growth has been lower. Now wage growth is higher and inflation is lower, and that tends to help with credit card debt. But it's something that everyone's worried about.
Neal, what are your thoughts on opportunistic funds waiting on the sidelines, hoping to capitalize on distress if the extent of distress is not as significant as previously anticipated?
I think we're definitely going to get to 25% in multifamily discounts. If that's not distress, what is? Home prices in the United States only declined 29% in 2008 crisis.
All right, I'm thumbing through a lot of cities again, picking out other non-city questions. Do you have any data and or opinions on real estate investment opportunities outside of the USA? Are there any particular countries of interest that might offer better opportunities than the USA?
The only one, well, there's a few countries that I think are going to do really well in the next 10 or 15 years. I don't know anything about real estate opportunities. So I'll just say that countries that are likely to do it incredibly well are Vietnam, India, and Turkey.
Do you think that situations forcing people to move to areas with lower cost of living will have significant impact on those areas? This person lives in Charleston, West Virginia, and they've spoken to multiple people who moved based on these reasons. If it's happening at scale, would it cause a noticeable difference in those markets?
Yes, those markets are going to get more expensive. Look at what happened to Phoenix. Look at what happened to Dallas. I mean, the same thing will happen to these markets.
Do you think because of possible oversupply of multifamily in Texas that it's not a good area to break into in 2024?
Early in the year, yes, but late in the year, you're going to get discounts. Dallas is still the best multifamily market in America. So you're getting a 25% discount at the end of the year in Dallas. I mean, come on.
All right, Neal, we are almost at the end here. I'm going to go back to throwing cities at you.
Well, we're actually over.
We are
We're a little bit over today, but we have a massive audience. There's still nearly 300 of you listening. Wow, you guys have amazing resilience. But you know, again, this journey doesn't end. We do this, you know, throughout the year. We actually update real estate trends and bring it back in the second half of the year. So you'll have another chance, another sort of shot at a chance to ask us questions. And if anybody misses stuff out, send me an email. We always respond to all of these emails. But with that, I'd like to say thank you, and thank you to Anna for all of the hard work in putting this together. And thanks everyone for attending. Have
All
a
right. Thanks,
wonderful
everybody.
rest of your day. Bye-bye.
Bye-bye.